Welcome to Taking Stock for the week ending the 15th of October 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. In our previous videos, we alluded to the drivers of this recent market correction, including inflation fears and the contagion from the potential collapse of Chinese property developer Evergrande. Now, with these risks in mind, we want to remind investors to be proactive with the management of their portfolio. Share market volatility creates opportunity. Take some profits off the table on stocks that have rallied too hard too fast and use the cash for future opportunities. Invest in companies with strong balance sheets, an economic moat, and wide profit margins to help you cushion these risks. Let's now also turn our attention to the US market, which has kicked off its third quarter earnings season. And analysts are forecasting another strong quarter, with earnings expected to grow by about 27.6% compared to the previous year. Interestingly, the proportion of companies issuing positive EPS guidance before the reporting season is 54%, and that's well above the 5-year average at around 39%. And the strong earnings momentum suggests that the actual results will likely beat analyst expectations, and this should favour US equities and stocks in our Lincoln US Growth Fund.
Yeah, earnings growth is expected to be driven by energy, materials, industrials, tech, and financial sectors. Hence, from a portfolio perspective, it makes sense for investors to have an allocation to these sectors. Some of our star stocks in this space include Netwealth, Aristocrat Leisure, James Hardie, Altium, Oz Minerals, South32, MA Financial Group, Lovisa, and Breville Group. Note that both Aristocrat Leisure and Macquarie are expected to report their results in November, with earnings forecast to grow by 72% and 14% respectively.
Yes, Jake. Interestingly, you mentioned Netwealth. Netwealth is an independent platform provider within the wealth management industry, and the company attracted around $4 billion in funds under administration for the September quarter, and that spurred the group to increase its financial year 2022 funds inflow target by a quarter to $12.5 billion. No doubt this will push up its financial year 22 earnings growth expectations, which is forecast to be around 15%.
Yeah, another stock I highlighted, Kien, was South32. This miner is exposed to a diversified spread of commodities, including aluminium, coal, nickel, lead, and silver, but has taken the strategic initiative to move away from fossil fuels by demerging the South African coal business and focusing on base metal opportunities. This week, it announced plans to acquire a 45% stake in Chilean copper mine, providing it with exposure to both copper and gold. This should help boost its earnings growth profile from the second half of FY22 should the deal go ahead.
Yes, we've had some positive star stock updates over the week, but let's now turn our attention to some of our recent initiations. Universal Store Holdings. We introduced this casual youth retailer into our star growth stock universe during this transition phase, and the company's strategy really revolves around the sale of trending apparel products catered towards the 16 to 35-year-old age group. But a few investors may be wondering why it's a star growth stock if earnings are expected to fall by about 24% this financial year. Well, under our growth criteria, the stock meets Golden Rule 1, financial health, and Golden Rule 2, past financial metrics. However, we believe the drop in earnings this year is caused by temporary factors, including the closure of stores due to government lockdowns and also the cessation of JobKeeper. In fact, growth is forecast to resume strongly in financial year 23 as the company continues to roll out new stores and expand its private label offering.
Yeah, another recent addition into Lincoln's star growth stable was retailer Beacon Lighting, BLX. The investment thesis is premised on Australia's buoyant property market, which continues to drive demand for lighting products. Similar to other retailers, growth earnings is expected to slow down this financial year as it cycles off a strong growth period on the back of a COVID-inspired home renovation boom. In fact, in its trading update earlier in October, the company mentioned that same-store sales had fallen 4.7% in the first quarter of the new financial year, but this was better than market expectations and has led to a positive earnings revisions on the stock. To drive growth, the company is shifting its focus towards online by launching a new US website and selling online into China.
Yeah, management are doing some great things here, but another favourable aspect of the company is that its share register is dominated by its founders, the Robinson family. It's also good to see that management retain plenty of skin in the game, which at last count measured up to 56% of the total shares on issue. But investors need to be mindful of the risks, especially given that beacon lighting is relatively illiquid, with an average daily trade value of around 290,000. And this may be insufficient liquidity for some investors, so please factor in this before establishing a position in the stock.
Turning our attention now to the week ahead, no star stocks will be reporting next week, though as AGM season heats up, there'll be a raft of companies announcing their trading updates. Some of these include REA Group, Cochlear, Macmillan Shakespeare, Brambles, Wesfarmers, and some other retailers. For income investors, there's MyState, Perpetual, APA Group, and Charter Hall Long WALE. Additionally, miners such as BHP, Oz Minerals, and Perseus are expected to release their first quarter updates across the week. And just hot off the press this morning, Rio reported its third quarter result, marginally reducing shipment expectations for iron ore by less than 1%. And the miners also reduced bauxite and refined copper production forecasts with ongoing industrial actions and ongoing works. Overall, this should have minimal impact on earnings expectations, with analysts having factored in lower iron ore prices across the last couple of months and observing buoyant aluminium and alumina markets. And for trend-sensitive investors, we've had a series of bearish SD Max signals from Pro Medicus, Perpetual, and Woolworths. Meanwhile, Sandfire Resources breached its SD30 TSR with 30% stop loss from its highs, following on from the recently announced Spanish acquisition and associated capital raise.
For Under the Microscope this week, we cast our attention towards a junior gold miner, Aurelia Metals. AMI is the code. It has 3 assets in New South Wales, the Hero Project, Peak Gold Mine, and also Dargues Project as well. You may be wondering why this stock has been selected as a star growth stock over the other larger players. Well, a breakdown of its operations reveal that gold makes up about 61% of its revenue, while copper, zinc, lead, silver make up the rest. The diverse exposure allows it to generate a high return on invested capital of 34%. Meanwhile, significant cash flows has helped it achieve strong earnings quality and also strong financial health.
That's right, Kien. And this week, the company announced a number of positive exploration updates suggesting that they have intercepted new copper deposits, which could extend the mine life of existing operations. And this is important because its Hera operation only has a mine life of circa 2 years, while Dargues is the longest with a mine life of circa 5 years. In addition, they've intercepted high-grade base metal and gold deposits at their Federation project, contributing to an ongoing feasibility study to turn the project into an operating mine in the near future. Management is targeting to have a portfolio of 4 to 5 producing mines within the next 2 years.
Moving on to Golden Rule 5, the company is on a forward PE multiple of 5.5 times, and investors might be attracted to this low valuation multiple. However, this discount is reflective of the company's active risks, which include its relatively small scale and shorter mine life. Note also that the company has historically traded around these valuation multiples as well.
Yeah, and keen eye investors may have noted that the short interest in the stock has risen across the past 3 months from 1% to around 3% of shares on issue, but it is still quite low. The company has a healthy number of shares traded daily with average daily liquidity of 1.6 million and a market capitalization of 420 million.
We have now finalised our star growth stock transition towards our optimised quantitative stock selection model. However, an important part of the process is our qualitative assessment of our star stocks. So a few members have asked us, how does the research team apply a qualitative overlay to our star stocks? One of the key qualities that differentiates us from some of our competitors is our qualitative assessment. The fact that you can contact our analysts to understand the fundamentals of the business allows you to assess whether the stock is suitable for you.
That's right, Kien. At Lincoln, we understand that a pure quantitative stock selection process has limitations, one of which is it tends to be backward looking. To resolve this, the analyst team assesses each company individually after it has been screened on Golden Rule 1, financial health, and Golden Rule 2, past financial metrics. We look at the outlook and active risks of the business, including earnings revisions. For example, have there been upgrades or downgrades to consensus forecasts in recent months? Because usually changes in earnings forecasts drive share prices. Abnormal operating impacts that could suggest recent profits are unsustainable. For example, profits may be driven by acquisitions or government stimulus measures. Changing competitive and structural landscapes that can lead to margin pressures. Management credibility. Director ownership and trading activity. Trend in short selling. Commodity price and exchange rate sensitivities. Regulatory, geographical and sovereign risks.
Thanks, Jake. And to understand how this works, let's provide an example with Platinum Asset Management, a global value fund manager. This stock screens well on our quantitative score with return on equity of 49% and net profit margins at 57%. However, we didn't introduce this stock due to the following reasons. Platinum has been marred by the weak performance of its main international and Asian funds, which has led to net outflows. This comes despite the severe growth to value rotation over the last financial year, which should have benefited its funds. There was also growing regulatory risks in China as well. Funds under management remain high at 23.5 billion, and it's still below where it was 3 years ago. Now, large funds under management make it difficult for Platinum to outperform. As a result, management fees declined by 4% and performance fees fell 56%, while staff costs have also risen 15%. And the reason why margins and return on equity have held up over the last period was due to the profits and gains from seed investments. These items are considered outside of their core operations. Meanwhile, earnings expectations have also been in decline as well. So all these risks mean that the stock is not suitable for star stock status. Thanks again, Jake, for your insights today.
Thanks for having me on again, Kien.
Now that our transition towards a more optimized star growth stock portfolio is complete, it's important for you to reassess your portfolio and look into our new star stocks. Under the tools, recent updates, you'll be able to find all our star stock changes. And remember, any further volatility in the market is an opportunity. Stay safe and have a happy, healthy and prosperous week, everyone.